George Soros didn't become famous because he made thousands of great trades. He became legendary because of one trade so bold that it earned him over $1 billion in a matter of weeks and forced an entire country's central bank to surrender. It sounds like something out of a Hollywood movie, but every part of it is true. The question is, what did Soros see that almost everyone else missed? And more importantly, what can ordinary investors learn from one of the greatest trades in financial history? To understand the trade, we have to go back to 1992. At the time, the British pound was tied to the European Exchange Rate Mechanism, or ERM. This system required participating countries to keep their currencies within a narrow trading range. On paper, it promoted economic stability. In reality, Britain faced rising inflation, weak economic growth, and high interest rates. Maintaining the pound's fixed value was becoming increasingly difficult. Yet, governments and many investors still believed the Bank of England would successfully defend the currency. George Soros wasn't convinced. Unlike most traders, Soros didn't simply analyze numbers. He studied how politics, economics, and human psychology interacted. His theory of reflexivity suggested that markets don't merely reflect reality, they can influence it. If enough people lost confidence in the pound, that very loss of confidence could become the reason the pound eventually collapsed. Soros believed Britain had only two painful options: continue raising interest rates to defend the pound and damage the economy even further, or abandon the fixed exchange rate altogether. Either outcome pointed in the same direction. The pound was significantly overvalued. Most investors saw uncertainty. Soros saw opportunity. Through his quantum fund, he built an enormous short position against the British pound, reportedly worth around $10 billion. It was an extraordinary gamble. If he was wrong, the losses would have been massive. But Soros believed the odds overwhelmingly favored him because the underlying economic fundamentals simply didn't support the currency's official value. Then came September 16, 1992. History remembers it as Black Wednesday. The Bank of England fought desperately to defend the pound. It spent billions buying its own currency and dramatically raised interest rates in an attempt to restore confidence. But the market was stronger. Investors continued selling and the pressure became impossible to contain. By the end of the day, Britain withdrew from the ERM and the pound plunged. Soros had been right. His fund reportedly made over $1 billion in profit almost overnight, earning him the nickname, the man who broke the Bank of England. While the phrase is symbolic rather than literal, it captures the magnitude of one of the most famous trades in investing history. But the real lesson isn't about making billion-dollar bets. It's about independent thinking. Soros didn't follow the crowd. He questioned widely accepted assumptions, focused on economic reality instead of popular opinion, and acted only when he believed the probabilities strongly favored him. Just as importantly, he understood that even great investors can be wrong, which is why risk management remained central to his approach. For today's investors, the takeaway isn't to short currencies or search for dramatic trades. It's to develop the patience to study fundamentals, the discipline to challenge consensus, and the humility to recognize that markets are driven by both numbers and human behavior. The biggest fortunes in investing rarely come from predicting the future perfectly. They come from recognizing when reality and perception have drifted too far apart and having the courage, preparation, and discipline to act before everyone else catches on.